Hello and welcome everybody. I'm Terry Ryder, founder of Hotspotting, and today I'm expecting a lively discussion with one of the nation's leading experts on housing finance and interest rates, mortgage broker Louise Lucas. Media currently is awash with misinformation on all manner of subjects, but nowhere more so than on the topic of housing markets, and in particular the impact of a rise in the official interest rate by the Reserve Bank. According to a lot of media coverage, life as we know it is over, because interest rates have gone from being the lowest ever to slightly higher than the lowest ever. There's lots of headlines which suggest that this cataclysmic event will cause property prices to crash. Of course, nothing is ever as bad as it is depicted by clickbait-seeking journalists. And today we're going to analyse what's really going on and what's likely to happen. And to help us to put some common sense into an irrational debate, my special guest today is renowned mortgage broker Louise Lucas of the Property Education Company. Hello, Louise. Welcome to today's attempt to put some common sense into the media debate about all matters finance and interest rates.
That's definitely you and me, Terry. Common and has some sense. So we got both. Hey, look at this glorious sunshine Melbourne's just produced. And all we've been hearing about overnight is the Arctic winds. I think, there you go. I didn't know the Arctic came down this far, but anyway, there you go.
We even have sunshine here in southeast Queensland, which hasn't been the case very much any time in 2022. But
no, wet again. Would you like me to share my slides? Can we get started with that, or do you want to share first?
No. You go right ahead and do your thing.
Okay, cool. Let's have a look. Okay. So, finding the good news in interest rates, because there is good news, didn't we? This is what our discussion leads to these. So, first up, people, why are you here? If you would like to pop into the chat and tell us why are you here and what can you tell us? Ask any question or just what do you want to find out and where are you from?
So you should be able to see a chat box in front of you. So just bang in your answer to the question, why are you here today, tuned into this webinar with Louise and myself, and the answers are starting to come through already. Louise, can you see those?
Let me see.
Chat box.
Yep, going for everyone. Go. Oh, that's nice. Hello, Luann. Hey, love hearing what Terry has to say. Good on you, Terry. Yeah, it's good to see this good side of interest rate rises. Cool. Southeast Queensland. Okay, cool. A balanced perspective. Yes, we like that too. Good, Harry. Terrific. All right. As we go through, if you've got any questions, Terry will alert me. Feel free to have a crack and let us know whatever you need to. And we'll do our best to at least discuss it, because most of this will be a discussion, but I've got a few slides just to share. So, I love showing this old photo of me. Terry gets upset because it was a great photo taken a long time ago. But I've been around a very long time doing this, and but I love mortgage broking. If you ever want to contact us, please jump on and get our newsletter and we give a quick 5-minute update each week on interest rates and things that are happening. Please feel free to scan the code and you can chat to us. It's really easy. Don't you love having QR codes now? And I got my own. We've got our own logo in the middle there. I'm very proud of that. I think it's really pretty. Oh no, this is general information. So if you go and do something silly, it's not our fault. Just so you understand that, be responsible for your own silliness. Thank you. Oh, but I am saying we have a best interest duty, but I can't do that until I've done a full assessment on you. So there you go. So what we're going to cover today, a bit about the media, the source of much evil, what actually happened to interest rates, and what are some of the many things you can do if you are actually worried, and who should worry and who shouldn't. So, of course, these articles come pouring out. This authority, Sarah here, house prices to plummet as huge interest rate increase expected. So, and Terry and I were just waffling on about this. Terry, give them your view. Come on. I know you're busting too.
Well, I mean, this headline and article probably encapsulates the general media stance, isn't it? We've had for 10 years, we've had record low interest rates. We haven't had an interest rate rise in that time. So we've got to this point where we've been for some time at record low interest rates. And now we've had one small rise, maybe some more to come. And according to mainstream media, that's pretty much the end of everything. House prices to plummet, huge interest rate increase expected. Well, none of those things are reality. Media loves to speculate. They love to indulge in negative sensation, particularly about house prices. Right now,
talking about why they write these headlines, because that's all people are reading, isn't it?
Well, it's all about generation of clickbait. I mean, to me, media these days is about inducing people to click on a headline, because a lot of people read media these days online. So if media can get you, the consumer, to click on a headline and go through to read the article, then they've achieved their objective. And the objective is achieved most readily by a headline that screams negative, crisis. And we're getting that with the housing market constantly. And very often it's dishonest. In fact, you know, we're researching media all day, every day as part of what we do, collecting information amongst the sensation. And what we find is that quite often the headline is a lie. It doesn't actually accurately reflect the content of the article, because the objective is just to get you to click on it. And
so it doesn't. Even you'll say that's the headline, then you'll read into it, and then you go, "Oh, that's not what they said at all." You know.
Well, that's not the headline makes a claim that quite often isn't supported by the information in the article. But at the very least, the headline is very often a sensationalisation of the content of the article and taking a very negative view. An example of that, I saw in our daily research yesterday an article which was in one of the Fairfax newspapers, which was probably the most negative media source about the housing market constantly. And it was about the Canberra market. And what the data showed was that there are over 100 suburbs in Canberra, and all of them had produced price growth in the last quarter, except 3. So what did they write their article about? They wrote the article about the 3 suburbs where prices had fallen and ignored the 100 and whatever suburbs where prices were still rising at quite impressive rates. The Canberra market's very strong at the moment. We're still seeing very good price growth there. Yeah. But that's the media mentality. That they'll search for a great pile of positives until they find the negative, and they'll focus on that, and then they'll sensationalize it. So we get headlines like house prices to plummet as huge interest rate increase expected. Yeah.
So that's why I suggest, do you know of Tom O'Toole? Terry, do you know Tom?
I don't know Tom O'Toole, but he looks like someone I might like.
I think you'd love him, actually. Tom is actually the Beechworth baker. He owned the bakery in Beechworth, and then went on to create a chain of these Beechworth bakeries across country Victoria, and he's done an incredible job. But one of his messages is he's into small business and, you know, creating all that sort of stuff. But one of his messages when he does a keynote was about the problem when his wife left him with all these kids, and he was trying to watch the news, and how, you know, unhappy he was. And he was saying, you shouldn't watch the news, was his message. But how he put it was this, so you won't forget. He said, you wouldn't let someone come into your lounge room and crap on the floor, so why do you turn on the TV and let them crap in your brain? So, and I just love that quote, because he's like, this is the way, don't listen to the news. That's what he's saying. And
look, he's absolutely right. And I think this pertains to property investment, the housing market, and consumers who are interested in it or involved in it more so than anywhere else. People often ask me for, you know, what's the secret to success in property investment? I say, well, here are the rules. Rule 1, stop reading newspapers. And people sort of titter because they think I'm sort of being...
Or they Google themselves to death. That's the other thing.
But I'm deadly serious. If you want to do well in the housing market as property investors, the first thing you've got to do is just tune out all the white noise in media, because you're not going to get any useful information from it. You're going to be misinformed, and you'll probably allow the negative sensation, which is a constant diet in media, to affect your perception of how things are and cause you to make bad decisions or cause you to make no decisions, make the decision to do nothing because you're expecting prices to fall everywhere. That was the case 2 years ago when COVID struck. Media was full of articles every day saying prices are going to fall 15%, 20%. Commonwealth Bank's worst case scenario was 33% drop in property prices. Never happened, not only in the history of Australia, but in the history of the world. And I mean that quite seriously. There's never been an instance anywhere that I know of where prices have fallen that much. Well, what we actually got in 2020 was actually price rises and the beginnings of a property boom. They got it so utterly wrong. So there's really nothing to be gained by
This is what happened to Tom. This is what happened to Tom. He's running a small business in a country town. They said, you may as well shut the door, mate. The towns are dead. It's all going to go. And he ended up creating a boom and a chain of them across and brought life back to these towns. So power to him. He's amazing. We could. So rates were always going to go up. It was just a matter of time, and here it is. So here's what happened. And we were talking about, well, what happened during this period, particularly in the GFC. We then got the big drop in interest rates. They actually seem to have raised them too high there, didn't they? What happened to house prices last time, these times when interest rates went up, Terry?
Well, this is a very important point, and it may be the most important lesson that I would hope that people will take away from today's webinar, and that is that media seems to assume that rising interest rate means prices will fall. Apparently they think that's logical, but actually, if that was to happen, it would be unprecedented. It's never happened before. Last time we had a period of rising interest, and you can see it on the graph there, that period from 2002 to 2008, we had a series of rises in the standard variable rate for mortgages, 22 increases, in fact, over that period of 6 years. What happened to property prices during that period? In most parts of Australia, property prices more than doubled during that period of very high and rising interest rates. And keep in mind that it ended up with people paying 8 and 9% on their mortgages. Right now, most people have mortgages that start with a 2, I think, Louise, maybe some with a 3, but yeah. Back then, people were paying 7%, then 8%, then 9%. Interest rates kept rising. And through that period, in most parts of Australia, not all parts, but most parts, we had house prices more than doubled in 6 of our 8 capital cities and most of our major regional markets. And if we had a graph going back to the 1970s and 80s, that's the last time before that we had a period of steadily rising interest rates. And at the end of the 80s, those of my vintage will very much recall paying 17% mortgages. And during that period when interest rates were in double digits and rising, we had the most extraordinary property boom in Australia. So the notion that rising interest rates mean prices will fall is certainly not based on historical precedent. And I think, that's where you would expect economists and journalists to go when they're trying to analyse what's likely to happen in this new era of rising interest rates. What will happen to prices? Well, based on historical precedent, we're not going to see prices falling.
Well, it was also, I was talking with Katie earlier from Hotspotting. We were talking about back in the late 1980s, you still went out and bought property. The interest rates weren't so in your face, and that media the frenzy wasn't there. So did it stop you? No. We had 3 houses at the time. We went and bought, so you just had to plough on. If you want to get ahead, you just, you deal with what it is. And what do? You cut down on other things, but you keep your house, we've been talking about. So, but Terry, here's the difference. What are the banks saying about? So we were talking about, I heard Alan Oster, the chief economist for NAB earlier this year, met him at a breakfast down here, and he was saying, well, over 2/3 of their clients have nearly 3 years worth of extra repayments in their offset accounts.
Well, that's right. And all of the major banks and some of the second-tier banks have come out in the past few weeks and said, well, they're pretty comfortable that their customers are going to be handled this era of rising interest rates because, as you just pointed out, most of their customers are well ahead on their mortgages. And that happened because, you correct me if I'm wrong, but when interest rates are falling, you actually have to ask the bank to lower your repayments. If you don't ask them, then your standard monthly payment stays the same. Most people didn't ask the banks to lower their repayments, so they kept paying the higher rate, higher than they had to, so this allowed them to get ahead on their mortgages. In fact, I think
also most of that money though, when that's the difference between a redraw and an offset. So people were actually paying extra into their mortgage when they're doing that. So they're actually paying it down quicker. But that extra money they've put in, because the repayment stayed higher, but they were only due to pay this much, they can redraw those funds and use them later to pay the mortgage again. To make the repayment. So, but offset account, people were actually, because we weren't spending during COVID, have all this money sitting in their own savings account, which is offsetting the interest. So they're saying, the bank's saying, we've got a lot of cash on the books that's sitting in people's offset accounts ready to pay their bills should push come to shove. Now, obviously, this is not everyone, and particularly first-home buyers, but I'll talk about that later. First-time buyers are not the problem. The problem are investors who have many, many properties all on interest only and are not paying them down. They're the ones who are likely to be stuck. Or if you've got all your loans on interest only, maybe you should be looking at a different rate.
The central message that's coming from the major banks and some of the lesser ones is that the vast majority of their customers are ahead on their mortgages, and I think it's a common situation for mortgage customers to be 2 or 3 years ahead on their repayments. And Bankwest said actually 90% of their customers are ahead. Various banks have had different numbers, but it seems like at least 70% of people with mortgages are actually ahead on their repayments. So that's one of the buffers in the system. The build-up of savings that you alluded to as another buffer, but the biggest one of all, I think, which media tends to overlook when they're talking about massive mortgage stress resulting from this rise in interest rates, is that when you're assessed for a loan, you're not assessed at the current interest rate, you're assessed at your ability to repay, assuming that interest rates are 3 percentage points higher than they are now. So,
well, actually now they're about 5. So they were assessing us all through the low interest rate period at around, the lowest they've been is around 5% or 5.25. But now they're heading back up to 7. So you might only be paying 2, but you're getting assessed at 7.
Yeah. So we've had, Matt Common, CEO of Commonwealth Bank, and senior people at ANZ Bank, people at Westpac, making various public statements recently. They feel that, that the extreme media talking about, a disaster because interest rates are now rising is a little bit over the top, and they feel comfortable that most of their customers are going to be able to handle this quite comfortably. That's not to say people are going to like it, of course.
No. But, and not to say that rates aren't going up. They do say, of course, rates look like they're going to go up at least another %, or 1.5%, and we expect a big increase this month, early next week. But it was interesting what Eleanor Creagh, the REA Group senior economist, said, that she doesn't think the RBA will be able to be anywhere near as aggressive as they are forecasting. And considering how poorly they forecast at the start of the year, saying they wouldn't be raising until 2024, and then suddenly they come out and go, oh my God, we're going to raise, because it's all a disaster, just goes to show what they don't know. And you think that you suspect that they are going to get it wrong again. But, and Alan Oster from NAB says, I'm an economist, so if I really knew what was going to go on, I wouldn't be working here, So at least he's honest enough to say it. But the others, they just keep, and people give them this huge amount of credence and power. And you've got to think about, well, how are you managing most of your, and how are most of your friends and family managing? Well, most people are. So keep going, So I love this. What are the banks saying? Well, I Googled Offset, and I didn't realise this chap's name is actually Offset. I thought she was offsetting him. That was the point of the photo. But no, it appears his name's Offset, and I can't blame his mother. I'm sure it was a self-inflicted name. But actually, what we're talking about with those Offset is the amount of money people have in that second account, and make sure your loan is actually giving you offset. So you should see on your statements that it says, oh, we've saved this much interest. So you're not paying interest on the full amount, just so everyone's clear. I know that seems maybe a little basic for those who do it all the time, but There's plenty of people whose accounts I've looked at after many years saying, oh, I thought my loan was offset, and it wasn't, because they'd never actually checked it. So make sure you actually look at what's getting charged and what.
Louise, do you think most people out there really understand the power of an offset account in terms of the impact on how much interest they pay and how fast they can pay down a mortgage?
People like it. It depends on how the individual manages their money, Terry. So how good you are at not overspending is the key. So how much can you leave in this offset account for the whole month? Use your credit card and not overspend there, and then pay it off in full at the end of the month. Works really well if you're good with your money. If you're not good with your money, then don't. It's less effective, you know.
So is the trick to basically have your income paid into your offset account and try and keep the expenses as low as possible to maximise the impact?
Yeah, and exactly. And I laugh because I was giving some talk last week to a group of renovators, and we're saying, you know, keep away from the sports bet and the Tats Lotto and all those sort of things. Don't go wasting money on things that, you know, are not going to help you. You know, don't do Afterpay. Don't do all those things that you can see them coming out of people's accounts, and we know you're just wasting money. So stop. It's not good for you, and it doesn't help. You know, you won't get any more satisfaction in the end, whereas you will get great satisfaction having paid off your house. You'll feel great.
I think one of the things that COVID has given us as a nation has given us plenty of unpleasant things, and a lot of people have got sick and some people have died. But one of the things that is perhaps an indirect benefit is taught people how to save, because they had no choice. They were restricted in what they could do, sometimes in lockdown, but not able to travel overseas. And I think given people an insight to just the power of savings, what you can actually achieve, it might actually be a benefit to a lot of people if they can carry those lessons forward.
Yeah, people didn't realise, like, oh, I didn't realise I could live like this. That's what I got. I got a lot of those sort of comments from people. I didn't realise how much I could leave in my account and save because I just didn't go out for a week or two. You know, it's amazing. So keep it up. It's a good idea. I just wanted to show the difference with when you get an increase. Say, we'll just look here on a 500K loan, and you get a 0.5 increase. That's an extra $200 a month. Is expected that's what you'll pay. Okay, so I just want you to realise that that's the sort of increase that you're looking at, and that's what the increase we're expecting next week. However, that's on an interest-only loan. All right, so you're just paying interest, no principal. Just leave it. Someone delivering. But here's the real kicker. See the same increase on a 500K loan is a lot less, $70 less, if you're paying principal and interest. Now, why? You're actually paying less principal off when interest rates go up, but the term of the loan doesn't increase. It just changes. The way they work out principal and interest repayments is you're actually paying more interest, less principal at the start of the loan, and as it goes further along, it changes. So I just think if you realise when you've got principal and interest loans, if you have all interest-only loans, you're going to be paying a higher percentage. It might, if in your repayment, than you realised, it might be actually cheaper. You've still got the initial hit of going to a principal and interest loan. It is more to pay, but your increases might be less. So maybe to split a loan, you can actually split a loan, which I think we talk about further down, and you can have some principal and interest and some interest only. If you've got it all interest only, you can actually mix it up. So it's just a matter of getting the right combination for you. But I would advise people, if you can, particularly in a rising interest rate environment, get onto principal and interest, start paying them on. And if you can't, maybe you got to look at what you should be doing with those properties. Anyway, just a thought. What affects the rates? Oh, look, today with rates, they love a low loan to value ratio. Okay, they like to give you a better interest rate if you owe less. So if you could actually manipulate one of your loans down, if the other one's higher, it can work better for you because you get a really good interest rate on a lower loan to value ratio. Does that make sense? Terry, are you happy with that?
I am. Yep, that makes sense.
And at the moment, I just want to give you a heads up, fixed rates are well into the 4s. 4% plus. And so people go, oh, you know, quick, I want to fix my rates. I go, well, I think that ship has sailed. And here's the thing. We've got all these commentary, like Terry just said, from CBA and from the, as I told you, REA's real estate .com.au's CEO saying the same thing, or chief economist saying the same thing. They don't think they're going to raise quite as desperately as they're alerting us in the media. So what does that tell you? At the moment, variable rates, if you've got owner-occupied and even investment, they're in the low twos. So why would you fix at 4% now? I'm just wondering. It just like, I understand some people just love the peace of mind, but I don't like paying more. So, you know, I think you should maybe, I can't tell you which is which because I've got no crystal ball. And I couldn't tell you which way, you know, it might end up. But inevitably, banks don't lose on fixed rate loans.
Is it the case? I've read some articles just in the past week that, in actual fact, whereas the standard variable rate has risen in line with the Reserve Bank's increase of 0.25 points, but because it's a competitive environment out there, the major banks are actually cutting interest rates to attract new customers. Is that the case?
They've been giving, well, I'll tell you what, rebates. They've been giving rebates as well. So giving cashbacks of thousands of dollars. And they have been, initially they all got excited and raised their variable rates. They were thrilled. And then they went, oh, this isn't quite working for us. So their fixed rates are now, because I gather their fixed rate funding is more likely to come from overseas borrowings for them. So that's higher for them because overseas has bigger inflationary pressures as well. US and Europe's got lots of problems. So when they're borrowing to get for fixed rate loans, it's actually higher for the banks here, but their variable rate, they get it from the cash rate, and that's still very, very low. It's we only went up 0.25, so it's very low. So the variable rates, some of them actually put them up and then put them back down again, down a little, or they're giving you bigger pricing discounts when we apply. So watch out for that because it is still worth going and harassing your bank for a bigger discount on your variable rate. And but the fixed rates, they are really tough at the moment. But the rebates, some are offering $4,000 to go. The banks with great service and that generally offer less.
Sorry, the rebate, is that as if you switch a current loan to them? Is that what you're talking about?
If you've got they're generally only for refinance, not for purchases.
Yeah, at $4,000 gift if you refinance with
certain lenders. From anywhere from 2,000 to 4,000, yeah. Some are even offering more at one point. I'm just like, wow. And what does that tell you? How desperate they are. But it's, is it a reflection on their service? Maybe. But anyway. Look, if you're worried, that was another point I wanted to make. If you're worried about being able to make payments further along and you're thinking, well, in 12 months' time, say rates are up 1%, how am I going to manage? Maybe you need to refinance now while rates are as low as we suspect they're going to be and extend the term of your loans. So say you're down to 25 years on all your loans, maybe increase them back up to 30 so you get that extra, reduce the repayment. And that might help you. So it might be worth looking at and getting onto that sooner rather than later. If you intend to do that and you're worried, get onto it sooner because it will be harder to service your loans the longer you wait. Because if they're up 1%, servicing gets more difficult as interest rates go higher because you're paying more. So you'll be able to borrow less, if that makes sense. So get onto that quickly. And split loans, like I mentioned before, maybe split them partially, fix if you really want some peace of mind about it, have some variable, you can have some interest only and some principal and interest. So mix it up and really assess each loan and each property and see what you're going to do. And if you can't, you think, well, none of this is going to help, but I'm very worried. Say rates did go to a 1% higher or 1.5%, how am I going to manage? Maybe you need to think now, well, I'm going to sell a property now and get cleaned up and get ready and organised rather than being under pressure and then really not being able to manage that process because selling is tricky and you need to have your wits about you because otherwise they'll bash you around the ears, those agents, just to get it off your hands if you're worried at all.
Louise, could you just explain a little bit why you would split a loan, the benefits of doing that and how it might work in simple terms?
Well, if you were worried about having a larger repayment, you might be able to say I've got $1 million loan, well, 500 I might fix and have two portions, 500,000 and 500,000. There's lots of advantages if you can, if you don't mind managing different multiple loans. You can split and fix one portion. You can split and have one portion interest only and one portion principal and interest. If you are converting a principal and interest loan into interest only, then the bank will do a reassessment on your ability to pay, because they are saying, well, if you can't pay it, then maybe you shouldn't have it. So watch out for that. Don't just go and say, oh, I just want to convert to interest only, because they don't like it. And because they're concerned that it might end up like you looking like you can't afford the loan and they've given it to you. So watch out. Another advantage is, say you split a loan and then you managed to pay, you had something for sale or whatever happened, and that 500K loan you could close. So your repayment is now halved because you've only got one loan of 500, not two. But so your repayment then is half what it was, all right, because you had two separate loans. But if you had $1 million loan and you put 500 into it, you're still paying the same repayment because it was still $1 million loan, and that's how they work it out over the period. So there is an advantage to split bigger loans down, in my view.
Okay.
Reduce your repayments or pay more quickly. So that's really, you could, like Terry said earlier, people have been paying a higher amount than they probably needed to. So you might like to check, if you're feeling under any pressure, get back control of that and reduce your repayments. I remember back in 1989, when they were sending us a letter every month that interest rates are going up. Every single month it seemed like we were getting an increase. It was so scary. We thought, well, where will it end? We never occurred to us to even, like, you was just keep going, head down, get another job on top. It was crazy, crazy times. But then 12 months later, it was back down to 11%, and hallelujah. But those who'd fixed in the middle were, feeling very uncomfortable now at 15%. At the time, they thought they'd done really well. Reduce your repayments if you want to get back control of that. You don't have to pay extra in ever, so you can just ring your bank and have a chat about that. And maybe the other option is, well, if you think you've got the money now and you're doing well, pay more quickly and reduce the loan, and that can help you too. Anyway, but the main thing is having a good look at it and reviewing and what you think. It's you that matters, and your budget and how you're going, not whatever else is happening in the market. But anyway, I love this girl. The minute the ABC were all fearful about interest rates, and they get this single mum living the dream here in her beautiful designer home, and she had someone had given her an interest-only loan, which is scary in itself. But she's happy to pay for, the gorgeous fridge and the lovely setup. So if you found yourself with an interest-only loan in a property that you can't afford but you want to keep, maybe you, before selling desperately and then solving that problem permanently, maybe you should try and hang on to the property and move into parents or friends and rent it out. That was the first thing I'd suggest you do. Secondly, maybe Airbnb some rooms. That's amazing. No matter where it seems to be, little rooms get rented for different reasons by a multitude of people. So there's lots of things you can do. Start getting into it and do it now. Don't leave yourself under threat under any circumstances. It's crazy, what you can do. But they're bleeding hearts, and how she got put into this with an interest-only loan meant she really couldn't afford it. And she's worried rates are going up and she can't afford it. So, deal with it. You cannot let that go. It's crazy. Always have an emergency fund. And if you haven't got one, start saving it. So you need to have some buffer in the system always. We usually say 10 to 20,000 must be kept just for a buffer. So you can actually do it in your loans. You can actually have a buffer set, an extra loan a split loan of 20,000 with 100% offset, or in Redraw, so that it's fully offset. You're not paying anything for it. It's just sitting there available for you in case of emergency. Often when people had family overseas, but they live in Australia for periods, they'll want a loan that gives them that surety that if they ever need to fly home in a hurry, they've got cash. You just need to have some money that's available. It's just prudent to do this, can I suggest? Yeah.
I think that's a great idea.
Well, I think it's really helpful just to give you that peace of mind. It's money. No one should be living in this country worrying about money. We've all got...
And it doesn't have to be a large amount of money you put aside on a regular basis. It's amazing how it builds up over time. Get started with it and you'll find in a couple of years' time you've got a tidy sum set aside by putting aside a relatively modest amount if you can do it.
Yeah, totally right. And now is your big chance to go and ask for that pay rise. People hesitate to ask, particularly women. It really, really irritates me. I really want you to say, use the excuse, my broker said I have to get a raise because I need it to pay my mortgage. Go use that. I don't mind. I'm happy to take the blame for that one, because now's your chance. If you can, go and ask for that raise. There's plenty of people who they're more worried about you leaving than staying. So if you're a good worker and you're doing the right thing, go and get some money. Oh, Terry's an employer in local, he might be. But
hopefully none of my team are listening to this.
Yeah, maybe. But I think maybe I'll have to coach them too. It's really important. Here's your big chance. Don't hesitate. And there should be pressure on wages. Wages have not grown in this country for years, they're saying. So now's our big chance. All those poor hospitality workers who've had years without any decent income for the last few should be desperately asking for more. And we're just going to have to pay for it. That's how it works. So, I just wanted you to look at your net worth. Where are you going? I do this every 6 months. I just think it's a good idea to give you actually I do it a lot more often, but a definite sit down and assess where you're at and where you're going, all your assets and your liabilities, and then get your net worth and then see how you're tracking, and do it so you keep a record so you can see, are you actually progressing or are you just overspending? So it's a great idea, and it does make you feel better about yourself. So have a go, I think. And what was I going to say? Oh, I just wanted to show people what happens. This Genworth is one of the major mortgage insurers in this country. And they have some fantastic magazine, journals, etc. on their website. And I highly recommend you go and have a look at them. But I wanted to just show you the process about what happens when a house is defaulted on and a loan is defaulted on in Australia. So it takes about 2 years for the bank to finally get around to, they threaten you, they do all this, blah, 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 blah. And then finally they will sell your home if you haven't paid. All right. So it's a very long process. The lender then lodges a claim with Genworth. This is their process, right? Genworth then pays the claim to the lender, and the debt then is assigned onto Genworth. And then Genworth sells the debt in a debt sale, and someone will come and then start harassing you for the money. So what do you do in these circumstances? Do not get to this far, hopefully. If you've sold, hopefully you're not in negative equity. One thing I wanted to point out is in Genworth's research, it is not, because the media goes, oh, you're killing off first home buyers. They're the ones who are all going to be struggling and defaulting. Generally, it is not first home buyers who default. That's not the cause of the problem, because those people are in their first home. They do everything they can to hang on to that home, and they pay their bills. So they might have borrowed high, but they manage, and they end up paying, what they can and keep at it. It's people who are refinancing. They're the big problem. And the other ones are people with multiple interest-only loans. And they're generally investors who aren't managing their money very well, but they think they're, buying all these properties and going great, but they actually aren't managing the debt. They're the ones that Genworth end up defaulting with and having this process. So if you're one of those, maybe look at it and get really serious about your money now and so you never end up in this circumstance. It's very, very small percentage of people this happens to in Australia, because we're not like the US. You are responsible, and they will chase you. It's a bit different. But anyway, but it's reassuring to know the facts support first-time buyers are not defaulting. You know, they're going well. So I just thought it was interesting. And have a look at their website. They've got a lot of great information there for you. Oh, if you want to know about calculating your repayments, what effect offset has, go to our website at Propertyaid, and we have a whole stream of calculators free. Just go and have a look, and look, you actually can get lost there for hours. It's really good fun, and it's worth having a look at. You can see the effect of offset, of redraw, of, you know, and you get an amortization chart to show you paying off and what you're doing. Okay, so I'm about done. So Terry, I'm gonna save that. Tell us any questions, or is there anything anyone wants to know?
There are a lot of questions and a lot of comments. I might start with a comment because Normie says that you're superb, and I thought you probably would like to know that.
Thank you, Normie. That's beautiful.
Brendan asking whether you could explain the difference between an offset and a redraw.
Yeah. Yes, Brendan, great question. It is tricky. So redraw, and this was really highlighted a year and a half or 2 years ago when ME Bank actually closed the redraw on a lot of their clients. So what redraw is you have, say, a repayment on your loan of $2,000 each month, but you've been paying in $2,200. And over the course of a year, you've saved up all this extra money and it's sitting in the loan. So the loan has the extra funds, not an offset. So the loan has redraw, but it allows you to, all those extra 200 you put in, you can now redraw. So that's allowing you to redraw from the loan, and it's like forced savings. Now, what happened with ME, which was hilariously bad management on their part, they just went in and said, oh, look, people have left all this money in redraw. We'll just take it from them because they don't need it. Like, we'll just reduce their loan down because they've paid the money into the loan. And the clients went absolutely ape, as anyone normal would think you would, and said, put our money back, because that was our way of managing or saving. And because some people prefer to have the money in the loan so that it's set and it's sort of like out of your hand. Then it's much harder to take the money back from the loan because you see the loan go up, so it's a bit depressing. So I think it's quite a great way to help people save and pay loans off quicker. And so ME had to reinstate all their redraws. So I don't think any lender's going to rush to do that again. But they don't like it on their balance sheet because it's no good to them. But it's the same with money and offset. So offset is a savings account attached to the loan, but it's actually a separate account. So the savings account is where you call an offset, and you actually have to ask the bank to, or set it up with your broker initially. So there's an offset account that's offsetting the interest in your loan. I actually have a video on it, and if you'd like a look, we're happy to email it to you, Brendan, too. So it's on our website. We have lots of, in the blog area, go and have a look at those, and there's lots of videos and things that might be useful to explain these things to you.
Now, Sharon is saying for an offset account, using an extreme case scenario, if I have a loan of 500,000 and I put 500,000 in my offset account, does it mean the bank will charge me zero interest and the whole monthly repayment goes to principal repayment?
Yes, that's exactly what happened. And I've had a client do that, which was interesting. When they first came to me, they wanted an interest-only loan for 500 because they had money in offset. And I said, why don't we make the repayment, if you can afford it, on a principal interest, but we're still going to offset. And they've paid off the loan within like 7 years. Where they got the 500 cash from was borrowed from parents who didn't, which is great if you can get it. So they actually, I know, how lovely. But they had, so hey, any parents who've got money sitting around, you're not getting anything, well, put it in your child's offset account. I love that idea for people. It's often really useful. So they can then make really big impact paying down their loans because you're right, the whole repayment goes to principal. So I've had a couple of clients do this. They fully offset the loan, but they still make a principal repayment every month. Okay. But your repayment doesn't go down. Like, because your interest, the repayment, because it's a principal and interest loan, remains the same. Okay. If you want to actually reduce your repayment, you have to rewrite the loan to a longer term to change the repayment. Okay.
Okay. Now, anonymous attendee is asking a question saying that I have multiple interest-only loans with fixed rate. The fixed term finishes in about a year's time. What can I do now to prepare for the increased interest repayments that I'm facing?
Well, it depends on your income. That's one of the how you're going to reassess then. If you want to keep all the properties, you might start banking cash as best you can, as quickly as you can, or decide what are you going to do about the property. Terry would maybe be good to help you assess each of those properties. Terry, you offer a coaching service with Property Review, don't you?
Yeah, a strategy session, a one-off strategy session is an option, or an extension of that is an ongoing mentoring situation. But certainly a lot of people can get a lot of value out of just a 45-minute session discussing their situation and talking about some of their options.
Because there might be properties in that portfolio that you might think, well, they might be better off moving off now, and unless you really want to keep them all. So you might say, oh no, actually maybe the time is right that I get rid of one and put the money in offset or cash and waiting until we come off and then I'm ready to pay. So it depends how much equity you have and where they are and what you've used and what your plan is for future. So you need to really assess your circumstances and get a grip on that.
Okay, there was a question here from James. How are interest rates affecting yields and investor outlook? Yeah, I think there's a lot of people thinking about that. And I think maybe people are worrying a little bit too much about it. One of the things that's very, very powerful for property investors at the moment is that we have these extraordinarily lowest ever vacancy rates in Australia, and rents are rising very strongly. In fact, we're getting to the point now where rents are rising at an annual rate as much or more than house prices are, which means when we get to that point, yields rather, are actually rising, not falling, because we've been going for a period because of rapidly rising prices where yields have been dropping, and people looking at a spectre of rising interest rates are starting to worry about the balance between those two things. But I think the market is going to fix that for a lot of people because rents are rising a lot and yields will rise with them.
And that's your excuse. Mind you, Terry, we had a good case of stupidity recently. Come on, tell them about. So some idiot vendor, we just have to lay it out there, come on, was trying to sell an investment property which had no tenant in it, which is what you want when you're purchasing, let me tell you, because you want to control who's renting from you. But by chance, this person put a new tenant in at a reduced rate. Why? Gobsmackingly stupid.
Yeah.
So not only does the purchaser no longer want to purchase, but that vendor's stuck with someone who isn't paying market rates for the next 12 months.
And the renters are a long way below market rate. So it's just a brain explosion by the vendor. Certainly hasn't helped themselves or their agent sell their property.
No. So, and don't you be that property owner who has, I let them there because they're really nice and I don't raise my rates. God knows, people know they don't want to move. Most tenants don't want to move when they're in a property, so you can afford to put the rates up. And watch out, because property managers are loath to rock the boat. They just want it rolling on, it's easier, and they're quite sympathetic to the tenants who are often like them, young, blah, blah, blah. So be assertive on this and get your rents raised. It's really important to actually, and it's easier for your broking and your mortgage broker and your servicing if your rents are higher, obviously. So maximise them as best you can. Keep an eye on it and assess your area each year. I often have agents in certain areas where I've had property, they email me all their newsletters because I want to keep an eye on what the rents are doing and what, it's really important to keep up.
Okay. There's a comment there from Linda talking about her husband and she gave enough money to their children, their old children's offset account. It saved them so much money and they were able to do a renovation.
Yeah, super. Well done, Linda. That's great. And what a great use of your money. You were not getting any. You're getting 1% at the bank. So why not put it in and make some contribution that way? And then it's still your money. You can get it back, Anyway, cool. I think we're almost done, are we, Terry?
Yeah, we're getting close to being done. Look, I think we could perhaps use the remaining time available for you to tell people what they can do, how they can get in touch if they've got a question, if they've got a situation, or just simply see the benefit of talking to a good mortgage broker.
Yes, I'd hope so too. So my challenge to you is we're going to offer to do this for people if they want. So one of the biggest problems, and the banks are seeing, is we need you to clean up your savings accounts and or your credit, extraneous credit. So we will offer to do an assessment for you of 3 months of your savings and credit cards. Do not just email them to me, please. We have a secure portal. We don't like things on email if you can avoid it. But if you would like us to do that assessment for you, we will offer to do it free. And I will arrange, you just ring us or email. I've got my details here. Please use the QR code and just connect with me, or there's my phone number and email. And just say, if you'd like us to do that assessment for you, we'll collect all your documents, do the assessment, and give you some insights into where you're spending and what you can probably save if you want to. So we can have that discussion together. No judgment. We've all got our issues. Mine is chocolate. So I feel free to say whatever you like. It's never going to be an issue, but it's good to be able to share and learn about it and take control of it. Never feel overwhelmed with money. I always want people to feel supported, because the money causes so many problems for people, or lack of money, or fights over money. We don't want that. We want you to feel like this is something we can always solve together. All right?
I remember you saying in one of our previous webinars together the importance for people, if you know that in the next few months you're going to be applying for a loan, start cleaning up your 3 months of expenditure now by cutting out those little things that might not look so great on a loan application. Trim your expenses just for 3 months, because that's what they look at, isn't it?
Yep, that's right. I had a gorgeous girl on a webinar, said she was emailing and said, well, I'll cut the Pornhub and Sportsbet now. I go, oh my God, she was only doing it to tease us, I'm sure. But anyway, it was funny. So, but they're looking at every expense and they're asking questions. I had them ask recently on a young fella. He's an electrician, he's earning really well. And they came back, they declined the loan to start with for no discussion, and then came back with this list of things. Oh, he spent something at something Propertyaid Limited. Is this a loan? But no, he bought something for his mother on Mother's Day, and that's how it came up on the statement. But that's what they're asking. That's how detailed they're getting. So watch out. That's what I'm just saying. Like, let's check. And so check for yourself and see what's there. And it's really important to keep it clean.
Okay, so it's probably a good point to wrap things up. Look, I urge everybody watching and listening to just have a chat to someone like Louise. And it doesn't cost anything to have that chat. I don't know how anybody out there as a consumer negotiates the minefield of all the different lenders that are out there, all the different loans, all the different interest rates, and all the other offers and conditions that are attached to loans, without the help of a good, well-informed and it's changing every day, isn't it? I mean,
Terry, since the raising rates, they're going up and down every single day. There's something new. They're all desperately, clutching it. What am I going to do? Up, quick up, move the fixed rates up. Oh, we move them down. Oh, we'll move them up again. Oh, we'll take the investment rates up. Oh, we'll take the owner-occupied down. Like, gosh, we are constantly getting bombarded with options on it. So, yeah. It's insane. So yeah, you cannot. We have full-time team just working on that.
Look, I urge people, don't try and make sense of this yourself. Talk to a mortgage broker. It doesn't cost anything to do it.
And mortgage brokers are now doing 69.5% of loans, so 70% of loans across the country. So there's a reason, because people need the help, and it's good.
Okay. All right, time to wrap it up. Thank you, Louise. Another fun presentation. But in amidst all the hilarity, lots of great information and good tips. And we've certainly got in the chat box today a lot of feedback from people. Thank you, everyone, for your comments and your compliments, saying that they find the information that you're presenting useful as well as entertaining. So thank you for that.
Pleasure. Thank you for having me. It's great to talk to everyone.
Okay.
If you want help, please feel free to call us.
Okay.
Close all them. Sorry, there we go.
The information is on the screen. No, it was. It's not anymore. Okay.
Okay, I can put it back, but
That's all right. Thank you, Louise.
Propertyaid, they'll find us. It's easy.
Let's do it again soon.
Thank you. Thank
Okay.
you. Bye, guys.
Yeah.